China's corporate debt to GDP ratio is 205%, whilst the US is around 80%. Do you see a problem there? The problem is China has a debt bubble that could turn fatal if not controlled. While it is true that the Chinese economy has great liquidity, it is no less true that its debt ratios have very much deteriorated indicators for years. For some time, some analysts have been warning about this Chinese debt bubble. There was a serious hint of a puncture back in 2015 to 2016 when the foundations of the new Chinese economic model rocked sharply, even threatening to collapse. But as suddenly as it came, the storm abated, and Chinese debt resumed its upward path in the most indebted sense of the word. Now there are new indicators that once again highlight the delicate situation of Chinese debt, and that seems to indicate that the situation is getting worse, which the final puncture may be approaching. What is worrying is no longer the current situation of Chinese debt, but the fact that the situation seems to only get worse. In fact, to this day, the matter has been getting worse for a few quarters. This is how it's clear how the intentions toward deleveraging repeatedly manifested by Chinese leaders have been left in a mess. One thing is to preach from the rooftops, and quite another to lead by example. According to Yahoo Finance, forecasts suggest that in 2022, China's total non-financial debt will reach 300% of GDP, rising by around a disconcerting 25% more than the closing levels of 2016. More significant in this regard is if all this new debt that is being created in China is of quality, or if on the contrary, it is of doubtful collection. The image in this regard is that this new debt that is being generated in the Chinese economy is of poor quality. The fact on which they base this claim is that private sector corporate profits rose by just 18% between 2011 and 2016, while profits for much less efficient state-owned companies plunged a shocking 33%. And you can imagine that, if corporate profits take these pessimistic paths between gray and passion red, the significant growth in debt cannot be accompanied by the good quality of it. Those who are borrowing do not seem to be going to be in very good condition to be rapid at maturity. The Chinese debt crisis is served. The only question is when. The reason that this unsustainable situation is being maintained over time. Even though many people have been preaching the downfall of China's economy and the puncture of this economic debt bubble which has seemed to defy all odds till now, as one can imagine, at least there are reasons why this may be happening, and why such an unsustainable situation as that of the Chinese debt could be dragging on for so long. The truth is that China has great regulatory and financial muscle. China is a decapitalist state which gives it the power to do and undo at will. It can also change the rules of the game from night to daytime, or to overregulate to put out the fires of the present without realizing that, in the long run, the process is just like pouring gasoline into the fire. China's financial muscle comes from its enviable economic strength derived mainly from its purely export model. Also, this buoyant foreign trade has allowed it to accumulate a huge volume of reserves, with which it can threaten to forcefully hit market players who dare to open bearish positions against its macroeconomy in any sense. But just as no evil lasts 100 years, no unsustainability can be balanced for 100 years. What the economic reality has is that it is even more stubborn than reality, and it always ends up being imposed against the wind, the tide, liquidity cannons, and overregulation sheets. But some ideological sectors defend the Chinese model as a socio-economic solution for the future, compared to what some describe as stale Western capitalism. One of their main reasoning is that the Chinese model has proven to be a great economic success in recent years, which is true, and they portend more success in the future. Faced with the high debt ratios, they limit themselves to saying that China has a solid financial position that would allow it to cancel all its debt if it wanted to. This is a fallacious argument that can be analyzed. First, let's assess China's total debt. As you may already know, the indebtedness of any country has mainly two aspects: public indebtedness and private indebtedness. The second is subdivided into corporate debt and family debt. If you've liked it so far, could you like the video and subscribe, please? Starting by putting differentiated figures on public debt, we can take as a starting point the figure published by Bloomberg, which estimated Chinese government debt in 2015 at just over $10.5 trillion at the time. And the truth is that after 2015, the trend has not ceased. On the other hand, the corporate debt of Chinese companies in September 2017 reached $18 trillion, which is 170% of GDP, while the debt of Chinese families at the end of 2017 was around $6 trillion. With both figures, it is clear that private debt in the last quarter of 2017 was around $24 trillion. If we add these debts, we can see that the total Chinese debt amounts to $35 trillion. With this shocking figure, the theory that the Chinese government can, with the value of its assets, cancel all the country's debt is not plausible. This is because such government assets are currently valued at about $19 trillion. In reality, even if it were viable, this possibility would not make much sense, since it is very difficult to imagine the Chinese government liquidating all kinds of assets, such as officials' cars, government buildings, public land, etc., to cancel its debt in a potential financial storm. But do not doubt that some will even refute that, since we have corporate and family debt in our equation. The corporate and family assets should also be included as part of the balance sheet. It is already unimaginable that, even in a decapitalist system like China, the government will deal with forcing companies and families to use part of their assets to pay off debts, even if partially. Therefore, contemplating the scenario and these assets are meaningless. Possibility of this would only serve violating the freedom and private property rights in its most constitutive and systemic essence, and it would be saying a lot even for a country that has the dicta in its system. However, one should not forget that it also has capitalism, and this has brought China delocalized production from the West, and also some unbreakable rules of the game. And the risk of breaking them is to lose the capitalism and remain in the dicta system, with all that it would imply. The implication includes a massive flight of capital, and then of companies, and this would only be an appetizer for what would come next. So, the best option seems to be that China deleverages as soon as possible, but this time it is for real. The longer they take, the more traumatic the process will be. Let's delve into China's private sector firms and organizations that are contributing to and affected by the increasing Chinese indebtedness. The real estate developer China Evergrande, the second largest in the country and the world, is facing a crisis of confidence that leaves it on the verge of bankruptcy. Recently, the Reuters agency revealed that the company has asked the Chinese government for help for an express IPO to solve liquidity problems. Beijing is facing a chain reaction that could affect the country's financial system, and a mountain of debt is about to erupt in China. China's Evergrande has the dubious honor of being the world's most indebted company with a liability of $120 billion. Its alleged liquidity problems have set off a chain reaction. The company's corporate bonds have had to be suspended from trading, following a 28% drop in the benchmark due 2023. The entire Asian debt market has been affected, and if this company defaults on one of its bond issues, the cross-default clauses of the other contracts would cause debts worth $20 billion to expire at once, and this could potentially jeopardize the stability of the Chinese financial system. All of the debt issued by China Evergrande has been shaken by the turmoil. Its yuan bond due 2022 fell 13%, and the bond due in 2024 fell 31%. But it also moved to equities in some of its competitors. Sunac China Holdings fell 4.6%, and Jink Properties lost 3.5%. The tremors were unleashed when it came to light that the real estate group had transferred liquidity problems to the Chinese authorities and requested a fast-track IPO of the parent company to reduce cash tension. Evergrande muddled through with a statement accusing the news of pure libel, but did not directly deny whether it had warned officials about a possible cash shortage. The company has defended that during the year it has obtained liquidity for 400 million yuan in the sale of projects. As confirmed by Bloomberg, Evergrande has already obtained the go-ahead to list its property developer from Hong Kong regulatory authorities to raise additional capital. But the big problem for Evergrande is that it has to get approval to list on the Shenzhen Stock Exchange before January 31st of the coming year. If it does not succeed, the holders may redeem their bonds early, and the repayment could amount to an equivalent $20 billion, which represents 92% of the company's liquidity. One other thing that also bothers creditors is that at least 5 Chinese banks and 2 funds have had a sit-down with Evergrande discussing their exposure and their access to collateral. An example of such bank is the Minshang Banxing Corp. That has near $4.5 billion exposed in Evergrande. Some other banks have also restricted credit lines to the company. Corporate debt in China rose to a record of 204% GDP in 2019 and has likely increased further this year as companies increased debt to recover during the pandemic. Evergrande is not left behind as they have also turned to banks, shadow lenders, and the bond market in recent years to expand well beyond the real estate industry into businesses ranging from electric cars to hospitals to theme parks, areas that are often aligned with priorities. The steps that China must take so that its debt bubble does not burst. For many years, investors, traders, and brokers took advantages of the differences between the interest rate of the U.S. Federal Reserve and that of the People's Bank of China. They lent cheap dollars and invested them to buy yuan, thus taking advantage of the spread. Given the trade discrepancies that exist today between China and the U.S., the extremely sharp rise in interest rates by the Asian country may slow down business activity and accelerate the slowdown in economic growth. On the other hand, the narrowing of the gap between interest rates, together with the depreciation of the Chinese currency, makes debt service in dollars more expensive for Chinese companies. Currently, it is very important to prevent the next depreciation of the Chinese currency. If the yuan depreciates further, China will have to sell off its assets, which will put additional pressure on the Chinese currency. The fixed control on the inflow as on the exit of the capitals and the prevention of financial risks is the primary task of China. The Asian country needs to carefully review the credit activity of companies, audit their loans, and monitor changes in the market structure. All international credits have to be used for projects carried out in the real sector of the Chinese economy, and not to carry out speculation in the real estate market and other spheres. Anyway, that's it for today. Tell us what you think about the economy of China, whether you believe it's all a power play built on a house of cards. And don't forget to like and subscribe.